So what is creative finance? I just define creative finance as structuring deals in different ways than just putting down 25% and using a conventional bank loan like most people typically do when they buy a deal. There's a few different reasons why you guys would want to use creative finance. One, you can get higher leverage. Two, you can get better security. Three, you can get better debt because you can start negotiating debt terms. Four, you have more flexibility, again, because you can negotiate a lot of these terms. And then five, you can create higher return on investments from structuring these deals in different ways. Just to highlight some of the deal structures we're going to talk about here, you have seller carries, and you have those on note and trust deeds and land sales contracts. Then you have seller seconds, which is just a second position loan that the seller gives you. We have subject to, we have wraps, we have lease options, promissory notes. We have seller giving you a HELOC or just using bank HELOCs. And then we're going to talk about transactional lending, private lenders, partnerships, and using hard money. So starting off with seller carries, like I mentioned, you have note and trust deeds and land sales contracts. So to make this clear for you guys, you have the title to a property, you have a deed of trust, and you have promissory note. So you can see the different boxes here kind of laying this out for you. But property title is just who owns the property. Mm-hmm. The deed of trust is how a loan is secured against the property. And then a promissory note outlays the terms of those loans. So with a note and trust deed, seller carry, you take title to the property and they secure themselves with a first deed of trust. So this is very similar to how a bank loan works. It's the exact same way, except for the seller acts as a bank.
Yep.
A land sales contract is also a seller carry, but it's a little different, as in property title does not transfer. So the title remains in the seller's name, and you record what is called a memorandum or a cloud on title against the title to show that you have right to own this property and take title once you complete X amount of terms, and it outlays the payment terms and all of the terms of the deal within that memorandum as well.
So if we talk about the note, that's just the terms of which you are borrowing, but it's not attached to the title without the trust deed.
Correct. So the trust deed will point to the promissory note, but the promissory note is not a recordable document. It's not shown on title. So the promissory note will say, hey, this amount is due with this interest rate paid back over this time. Mm-hmm. And the deed of trust may have the full loan amount, but it won't have all the details of the payment schedules and all of that like the promissory note does. And you can have promissory notes without deed of trust as well. So if you just borrow money from someone, you can generate a promissory note and outlay all those terms and not have a deed of trust. Again, the deed of trust is used to secure the loan to a property specifically. And when I say secure it to a property, meaning if you break the payment plan there, they can foreclose on your property because you have this deed of trust secured to the property.
Right. So in a lot of the creative deals we're going to talk about, sometimes you just have that note, but we don't need to secure it. It gives the seller a little bit more protection if you secure it to the property, right? But for the buyer, maybe it's ideal just to have the note.
Yeah, there's different times and places to structure these deals in different ways.
Awesome.
So going back to clouds on title in the land sales contract where you record a memorandum, all this means is when you have a preliminary title report, which is something escrow, a title company, gives you to show everything that is secured to the property, is that it is on this report. So as you can see in this example, you can see deeds of trust recorded, different liens against the property, and anything there. So this is where that would show, and it would just show, hey, there's an agreement between these people, super vague, you can find the document here.
So why this is useful is because if you are purchasing from a seller and they're staying on title, you want to make sure that they can't sell it to anyone else, right?
Correct. So when you record a cloud against title, if someone else were to go purchase that property, they would see that there's a prior agreement on the title report there.
So Trevor, what would be the benefit to buying a property and not transferring title? Why would you do that as a buyer? Why would you do that as a seller?
Yeah, so as a buyer, typically you want to do a note and trust deed and take title to the property. It makes it easier later on to refinance and do other things. With a land sales contract, you can still do all that. It's just slightly more complicated. For a seller, they typically want a land sales contract because they get to remain on title, so it's easier for them to foreclose on you and take back the property. And they also have some benefits of not having to pay back depreciation recapture at that time. So here's a seller carry example of a deal I bought. I purchased this thing on a land sales contract. I bought it for $1.6 million. I put 8% down. And to show you guys how you can get creative with these deals, we set adjustable loan terms. So for the first 2 years, we did a 5% interest rate. And then for the last 8 years, we did a 6% interest rate. And then the full loan amount is due in 10 years. So we were able to change the loan amount year over year. And we set it to interest only. So we're only paying interest on this loan, no principal, so we're not paying it down at all, which increases our cash flow. But we were able to do that because it's 100% negotiable between us and the seller. So for example, we could have made this a 5% interest rate year 1, a 6 year 2, and then a 4% year 3. It doesn't matter, it's whatever both parties agree upon.
And that's all going to be laid out in detail on the note.
Yeah, so on the promissory note, well, in this case, because we did a land sales contract, it's all in the memorandum there, and there's a promissory note attached. But within those documents, yes, it lays out all the loan details.
Got it.
We liked this deal structure because we were overpaying for the property, but they gave us 10-year debt, so we were fine because we knew we could improve the value of the property over that 10 years. And they gave us a favorable interest rate that let us cash flow along the way. And then we were able to put 8% down only. So if I went to the bank and tried to do the same deal, I probably would have had to put 30 to 40% down on this specific deal.
Yep.
So there were a lot of benefits we were able to do with this deal, and we also made it a win for the seller. So they had under market rate rents on this property. So the interest rate we're paying them makes them essentially the same amount of money they were already making, and they now don't have to do anything. And then we get to go improve the property and have the benefits over the long run.
So when you were underwriting this property, were you at all concerned putting 8% down about refinancing on the back end, or what was your plan for that?
No, because we have long-term debt and a good interest rate, so I could sell this property creatively too. So I could go sell this property to someone else with similar terms. So there's a lot of different exit strategies, and we knew we could improve the value, so we have different paths we can go. And then I'm always a fan of long-term fixed rate debt, so if I can get 10-year debt, you're pretty safe.
Got it.
Here's another seller carry example deal. This one's a single family home. It was purchased for $335,000 with only $20,000 down. So this is another creative one in the way that we did a 5.5% interest rate for the first 2 years at interest only, and then it changed to an amortization schedule after that.
Got it.
So the benefit on this was purchased at a time when interest rates were above 7%. So it's a lower interest rate, and we got to come in with $20,000 down on an investment property. So the client we helped purchase this, they would typically have to put on a $335,000 home, something like $80,000 down, so significantly less.
Yep. So you got interest only for 2 years. That helps your cash flow right when you start, and you got only $20,000 down. Was this also an overpay, or what did the seller get?
This was just a normally priced property. The seller wanted to do this because he just wanted passive income. So he didn't necessarily want to get rid of all the income from his rental. He didn't need all the money up front. He got to defer taxes by taking payments over time.
Yep.
So it was a win-win for both sides. Now we're going to talk about seller seconds. So seller seconds are another form of seller carry, but they get a little more creative, as in you're typically mixing them with bank loans, although you can mix them with other forms of money as well. But right now we'll just talk about conventional loans. So a seller second is a second deed of trust. So if you remember, I said there's title to the property, who owns it. There's a first deed of trust, which is the loan against the property, and then a promissory note. With a seller second, we just have a second deed of trust. So in order of who gets paid back, you might have a bank loan in first position and then a seller in second position here. That's why it's called second. The bank would get paid back first if there were a foreclosure, and then the seller second. So in this case, you get to mix bank financing with seller financing. So you can do this with conventional loans and all sorts of different loans in different ways. But you have to follow LTV guidelines typically if you're doing it within closing. And the benefit to doing this is you can get rid of PMI and you can get a blended interest rate. So with a normal conventional loan, when you put 5% down, you have private mortgage insurance, which is just an extra fee that you get charged for putting so little down. And then once you have an 20% down, so an 80% loan on that first bank loan, they get rid of PMI. So you could come in and put 5% down, have an 80% bank loan and a 15% seller carry and get rid of PMI. Not only that, you could blend, the bank loan and the seller carry at different interest rates or different amounts, so you can get a blended overall interest rate. So this is an example of a single family home we helped a client purchase. He owner occupied this home. He bought it because there's an ADU and a garage, so he would live in the main house, rent out the extra spaces, and then he goes and moves to the next, and then he just keeps on repeating this model. So he purchased this thing for $1.18 million, and we set this up creatively using a bank loan and a seller carry. So we set up a 50% seller carry at 4% interest only, and then a 45% bank loan at 7%, so he could get about a 5.5% blended rate overall. And realistically, it's a little lower because we did interest only on that seller carry, so his payment's even lower than it would be on an amortization schedule. So the other benefit to this is because it was such an expensive property, you go past certain loan limits and you go into jumbo territory, meaning you have to bring more money down. And that's just if you have a first bank loan over that amount. So we were able to bring the bank loan under that amount, letting him put less down and get better rates on this deal. So the benefits are a blended rate in this case, same amount of money down, and then he got a way better rate because we structured it with this seller carry at a lower interest rate.
And he had no private mortgage insurance?
And he got rid of PMI in this case as well because the bank loan was under, 80%.
And the last benefit that he got is since the loan to value was so low on that first loan, he got a better interest rate because for pricing, if you're putting a lot more down on your first position mortgage, your rates are better.
Yeah, so to clarify that, if your bank loan is at 80%, you get a certain interest rate, and if it's at 75% and lower and so on, your interest rate gets better. This is an example of a fourplex we helped a client with. We structured this one with a seller second as well. So this was a $730,000 fourplex that they were owner occupying with 5% down, and we set this up with a 20% seller carry. So in this case, the seller wasn't willing to negotiate on rate that much, and we got a 7% bank loan and a 7% seller carry. So we didn't get the benefit of a blended overall rate, but we still got to get rid of private mortgage insurance, which saved him about, it's something like $600, $700 a month. And because we did a 20% seller carry with 5% down, the bank loan was at 75%, which gave him a better interest rate on that bank loan as well.
Why would a seller sell on these terms?
Yeah, so there's a few different reasons. We went through 4 different examples of seller carries, and they all had different reasons. Sometimes people just like collecting interest, so now you get to make money on your property, right?
Yep.
So you're now lending that money, you are the bank, you get to make money. Other times, we just hit the price that worked for them, and they wanted a specific price and didn't care so much about terms. And then after that, sometimes it just works and they want to sell the deal, they want to make it work, they like the buyer for whatever reason, they're willing to get a little bit more creative. So every single deal is different, but the important part is understanding what your options are and then what the seller motivation is so you can truly make it a win-win. If you don't make it a win-win, the seller won't do this. If you offer them a 0% rate and a super low price, no seller will take that and you're just wasting your time. So you have to fully understand the situation and how you can make it a win for yourself and the seller still to make it work.
So when you're talking to the sellers or the seller's agents, you're asking a lot of questions to try to figure out what a win is for them on the front end.
Yeah, we're figuring out, are they doing a 1031 exchange? What are they doing with this money? Are they just putting it in the bank? And when I say 1031 exchange, we want to know that because are they going to buy another property? How much does this other property cost so we know if they need all that money or not? And those are all questions we're asking, plus a ton more to figure out their situation. Thanks for watching that section, and click the link below to shortcut your path to owning rentals and learn how you can structure these creative deals.